Hello and welcome back to Wise Credit Management. This is Lesson 3, How Credit Scores Work. We're going to talk specifically about credit scores. We're going to talk about why lenders use credit scores. We're going to talk about what a good credit score is, and we're going to discuss what makes up your credit scores. And we're going to get pretty detailed about the exact numbers that go into your credit score. So let's get started. And hey, if this is your first time joining us, we're so happy to have you here. This is just a short introduction and a review of the Essentials class. We have several pretty simple goals for the class. Mainly, I want you to understand the principles of wise credit management. My name is Jason Johnson, and while I was an active real estate professional, I focused on first-time homebuyers, many of whom needed help with their credit. Then one day, I believe that God put it on my heart to develop the program that I wish existed for people with credit problems. I know this class isn't the most entertaining, but I believe that it will be the most informative for you. It's completely free to students. It's the most comprehensive program that I know of, and if you pay attention and learn the material, you will be able to build and maintain a good credit score to help you accomplish your goals. I want you to learn how credit really works while being simple and avoiding too much complicated math. It's wisdom that works in the real world. All views expressed are my own and from my experience as a former mortgage professional. Just like your accounting professor won't do your taxes for you, I can teach you how the credit system works, but I can't help you with your credit. On the other hand, what if you do need a professional to help you out? Well, we do have members that can help you. Most real estate professionals can't, or rather shouldn't, try to help you out with your credit because it's just not what they do. You don't really need to understand something as complicated as credit algorithms. You just need to know someone who can understand it. If you need help with getting a good credit score or buying a home, we have a directory of professionals who are ready, willing, and able to help. The directory also has many other types of professionals who you might need along the way. I'm not endorsing any specific company or service, but if that person lists their company on this website, you know they're willing to help you on your journey. And if you don't want to call professionals one by one to explain your situation and see if they can help, you can go to wisecreditprofessionals.com and write one time about the details of your situation, then sit back and let up to 3 of our Wise Credit professionals contact you about how they can help. I show you a lot of screenshots of other companies' websites so that you can see where the information that I get comes from, but the class is considered a new work for education and commentary purposes and therefore does not violate copyright law. Many of the screenshots that I use are directly from the company that calculates your FICO credit score and from the big 3 credit bureaus. We do offer affiliate links, and I would appreciate if you use them, but I also strongly encourage you to use the affiliate links of the other members. When you open accounts with one of these companies, you'll get your own affiliate links offering either cash payments or statement credit, which could add up to over $1,000. And you can see how easy it is to forward the link to this class as well as your own affiliate links to anyone who might need this class. And if you want to see what new opportunities are available since I created this video, you can go to the home page and click on Options and Opportunities for you. This is where you can find our directory to local professionals and not just someone on the phone offering you a rate they can't actually give you. And you can also find affiliate links to other companies that can help you along your journey. Guys, who wishes I would talk just a little bit faster and make the videos just a little bit shorter? Well, I can. Just go to your settings and adjust the playback speed. Guys, thank you so much, and with all that having been said, let's begin. We get a lot of great advice from the book of Proverbs, and specifically relevant to this conversation, be prudent and acquire knowledge. This is going to take a little bit of time, but if you see where the exact scores and the exact numbers come from, I feel like you'll be better prepared to make decisions that help you manage your credit effectively and get the best credit score that you possibly can to qualify for a mortgage. Credit scoring is complicated, so if it gets confusing, don't worry that much about it. We teach a lot of principles here. Just know that it is actually complicated. And we don't know the actual algorithm. In other words, there's a step-by-step formula that no one outside of the FICO company knows, but we're going to try to simplify the scores themselves and teach you, like I said, to manage and maintain your credit effectively. The FTC defines a credit report as a summary of your personal credit history, in other words, a historical document. The FTC goes on to explain that a credit score is a number based on your credit history. And remember that each bureau has different information on you. Might be slightly different, but it oftentimes leads to different scores for each bureau. So remember, there are three main bureaus: Experian, TransUnion, and Equifax. So let's take a minute and talk about why you would have different scores from each bureau. Right here, we're looking at Equifax, TransUnion, and Experian. You can see that these are all very close numbers, but they're not exactly the same. Your credit score is a numerical result of a mathematical formula that takes information from one of your credit reports. In other words, it gets the information from this score comes directly from the information from Equifax, this score from TransUnion, and this score from the information on your Experian credit report. Oftentimes, slightly different information is used in each credit report. Sometimes creditors actually report your history differently based on the day that they report it. They report your information in batches, and different batches based on whatever day they report it might actually have different information, different balances, different days in that report. There are differences in the information that they report. It's not your fault. It's no one's fault. It just gets reported differently. Also, one thing to keep in mind, not all creditors report to every bureau. I know that doesn't sound fair, but the fact is that sometimes, especially when we talk about collection agents, they don't always report to every bureau. And all of that means that each bureau has different information for the mathematical formula to create your credit score. Therefore, each bureau can have a different score. So that's why you have different scores. Okay, in this class, I specifically make sure that all of my students know that personal information such as race, gender, age, employment status, looks, clothing, charm, they're not factors in your credit score. So I want everyone to know that regardless of what race, what gender, what age you are, you can develop a good credit score. And down here at the bottom on this website, I want to mention that something that's not and what's not in a FICO score, whether or not you are participating in credit counseling of any kind. We're going to talk more about that in lesson 7 and lesson 8, but participating in credit counseling, the notation doesn't affect your credit score. Other things involved in credit counseling would affect your credit score. We're going to talk about that in, like I said, lesson 7 and lesson 8. But remember that your credit scores don't know anything about you as a person. It only knows your credit history. It only knows the information that it's given based on your history of repaying loans. So credit scores are not prejudiced, sexist, ageist. They don't care if you're unemployed or the president of the United States or a company or self-employed, they're not impressed by presentation. Wearing a tie isn't going to make your credit score any better, and they're not influenced by your charm or personality or a smile, which I don't have a great smile, so I'm not even going to do it to you. So, this is the quote that I came up with. If anyone asks, credit scores are an objective way to calculate lending risk based on credit history. That's my quote. So, what I want my students to understand specifically is that credit scores are objective. It's just the end of a mathematical formula based on your credit reports and your credit history. Well, what are good credit scores? Our friends at Experian give us these ranges. 800 to 850 is exceptional, 740 to 799 is very good, 670 to 739 is good, fair is 580 to 670-ish, and poor is 300, and really it should be 350 to 579. But those are basic guidelines for what's good all the way down to what's poor, or what's exceptional down to what's poor. Credit scores, Experian defines, and we're going somewhere with this. Experian defines credit scores specifically. A credit score is designed to predict your likelihood of falling at least 90 days behind on a bill, any monthly payment, within the next 2 years. Well, the reason that lenders will use credit scores to determine, like we talked about in lesson 1, your interest rates, or specifically whether or not they'll approve or decline your loan, is because they have proven to be an accurate predictor of whether or not you will fall behind on your loan. And right here we can see that in this particular graph. If you have an 800 or better credit score, there is statistically a 0.7% chance, in other words, a historical fact, that you have a statistically 0.7% chance of falling behind 60 days or more on a real estate loan within the first 24 months. On the other hand, if you have less than a 600 credit score, you have a 27.6% chance statistically of falling behind on that mortgage payment. So that's why lenders use credit scores to determine risk and to determine interest rates. And next, I wanted to point out the differences between the Experian app and the Credit Karma app. Over here on the left, you can see Experian shows you your FICO 8 score. Okay, and we keep talking about my FICO. That's the scoring model that most lenders use. On the other hand, Credit Karma over here uses what's called a VantageScore. We're going to talk more about a VantageScore here in a moment, but Credit Karma does not use your FICO score. They use VantageScore. And what's VantageScore? Well, it is a scoring model that was created by the three main bureaus back in 2006. It's widely available for free from a lot of different sources. Guys, it is a real credit score, but it's not the one that's used by most lenders. So if anyone ever says, no, it's not a real score or something along those lines, it is, but it's just not the one that you really need to go by. And one thing that I did want to mention, as we're going to see here in a moment, VantageScore 4.0. So most of the time, those free scores that you get are VantageScore 3.0. However, here in the near future, mortgage lenders might start using 4.0. They've been cleared to use it, but most lenders still use the FICO 2, 4, and 5 that we constantly discuss. VantageScore 3.0 and FICO 8 have ranges from 300 to 850, and our friends at Experian articulate this fairly well for us. if you read between the lines, it says what I'm leading up to. Good credit for FICO is defined as a 670. Good credit for VantageScore is defined as 700. Now, I've seen it based on my observations, based on a lot of other people's observations and the scores that they self-report having. VantageScore is usually about 30 points higher than FICO. So whatever you have on your Credit Karma, you can probably subtract about 30 points to get an idea of what you will have on your FICO 8. And like we discussed, coming soon, and in fact, it's already been approved, but the VantageScore 4.0 and FICO 10T can be used for mortgage approval. Now, the 4.0 is obviously one generation beyond the 3.0, but the FICO 10T model, and we've already discussed that earlier, but the T is for trending data. In other words, it looks at your most recent 24 months worth of credit history and specifically whether the balances on your accounts are increasing or decreasing, and it adjusts your score, I'll say slightly, based on, in my opinion, it would only lead to 5 to 10 points, somewhere along those lines. Unless there's a dramatic change in your accounts, it would only account for maybe 5 to 10 points on your FICO score, but the 10T seeks to determine whether your balances are increasing or if you're paying down debt. Over time, that would lead to a slightly higher score. There are minor differences, but it's the same principles as what we've been teaching. So ask your lender what model they use. And as I've mentioned before, the Fair Isaac Company, it was started by a couple of mathematicians, William Fair and Earl Isaac. They created the FICO score in 1989. They sell the FICO score to lenders when you apply for a loan. And 90% of all lending decisions, in other words, it's an industry standard to use, 90% of all lending decisions are made with FICO scores. And you can get those scores through myfico.com. So FICO itself uses an algorithm, in other words, a series of steps. It's not just a simple 1x plus 2y minus 3z. It's not something nearly that simple. So you can't use regression analysis to determine exactly what the formula is. It is based on past data from other people to look at how likely it is a person is to become delinquent. So basically they looked at other people in the past and their situations, trying to determine how likely it is for you with this particular credit score to become delinquent in the near future. It's proprietary intellectual property. In other words, it's a secret. And always remember that when we talk about these scores, sometimes I get really specific. I'm trying to use as accurate and detailed knowledge as I have available, but as we'll see, it isn't an exact science that I have to go off of. I don't have perfect numbers to tell you, but we're going to get pretty close. So remember, it's a example and illustration, not exact math. Remember, we've got different versions. I always teach to FICO 2, 4, and 5, but there's also auto lending and credit card versions of your FICO scores. There are 5 main factors for FICO scores. 35%, in other words, quite a bit of it is your payment history. 30% is your utilization. 15% is your length of credit history. And then both 10% is new credit and your credit mix. So that gives you an idea of what the most important factors are down to the 10 percenters down there at the bottom. By the numbers, and I include this, guys, you do not need to know this, but this is the finance major from Baylor coming out at me. I had a question with regard to exactly how many points were available, and what I determined and what seems to be the correct answer is if the lowest possible score is a 350 for your FICO 2, 4, and 5, the lowest possible score being a 350, the second lowest score being a 351, all the way up to a perfect score being 850, that gives you 501 possible points. In other words, there are 501 available points for you to get. So if you multiply the percentages that we have based on different factors by 501, that gives you the number of available points for that category. Now, like I said, I try not to get that detailed, and that's really more of a side note, but it might be of interest to anyone who says, hey, there are 501 points available to you. That's where that comes from. So there are five main factors, and these are the points associated with each factor: 175 to payment history, 150 to utilization, 75 to length of history, and 50 both attributed to new credit and credit mix. 35% or 175 points goes to payment history. Now, payment history is the ratio of on-time payments. This gets a little bit complicated, but the way that I want to explain it is that one open account for 1 year is 12 on-time payments. Okay, you don't actually have to have a balance on that particular account to have it count as an on-time payment. In other words, if you just have your Netflix hooked up to your Capital One card and you pay your Capital One card on time every month, then that counts as a on-time monthly payment. On the other hand, if you don't have any kind of payment going to that account, it will still count as an on-time payment. Now, if you don't have any activity on that account, and this is where it might get a little complicated, if you don't have any activity on that account for up to 6 months, the account becomes inactive. So if I can suggest to you that you keep, like I said, a subscription account, your cell phone bill, spend something on it, even if it's just 1 tank of gas, something that you need to buy anyway, to keep a credit card account open and active, that will keep your on-time payments going, and that builds the length of credit history. And we use credit history in terms of months, so that's the way credit history is measured, in terms of months. Now, this particular we call it a FICO illustrative scorecard. This gives you a rough approximation of how many points are attributed to this particular category. Over here, what we see is a number of months since the most recent delinquency. This gives you an idea of what happens when you become delinquent. So over here, we've got 175 points attributable to payment history, and not being late on any account is 75 of those points. Well, what happens if you have a serious delinquency? In other words, a 30-day late, it winds up knocking 65 points off of your credit score. On the other hand, if you don't have any more delinquencies, as that delinquency gets older, you start to get points back. So between months 6 and 11, you get 5 points back. Between months 12 and 23, you get 25 points back. And if it's been over 2 years since a delinquency, you get 55 points. So kind of what I'm trying to articulate here is that one late payment can drop your score 65 points. Guys, use auto payments. If at all possible, if you're at all comfortable with hooking up your checking account to your credit card and putting auto pay on there for your minimum payment, just to make sure that you're never late. Guys, believe me, it happens. Life gets away from all of us, and you wind up with a late payment, and all of a sudden that costs you 65 points, and it haunts you for a couple of years, or well, for 7 years, but it really costs you up until this 2-year mark. That's one of the things that I wanted to point out. Next, we've got utilization. So 150 points go to utilization, which is the ratio of a balance to a limit. In other words, what was your high limit on this account? If you've got a credit card for $100 and you have a $1 balance on that, that gives you a 1% utilization ratio. It's measured as a percentage, and it basically means that how much money have you used compared to what you have available. The percentage itself is what matters, not the actual dollar amount. So always remember that if you've got a $100 credit card or $1,000 credit card or $10,000 credit card, the percentage is what accounts for the points and not the dollar amount. So back to the FICO illustrative scorecard. As we discussed, we've got 150 points available in this factor. With no revolving trade lines, you're going to have 30 points to start with. If you have one or more trade lines going, the cumulative, in other words, the overall utilization, the total utilization, if you have it under 6%, you get 65 points just for this particular category. So as your balance goes up, in other words, as the utilization rate goes up, your credit scores go down from 65 to 50 to 45 to 25. Then at 90% or more, you only get 15 points. So literally from 50% on, it's costing you more points than not having any credit card in the first place. So keep your balances on your credit cards as low as possible. Under 6% is what's articulated here in the FICO scorecard. Later on in lesson 5, I'm going to show you how it's actually 1%, but we use under 6% because of this example. Also, one thing that I wanted to mention, utilization ratio for revolving accounts is called utilization ratio. But for term loans, FICO still counts your balance compared to the original loan amount. So as you pay down a term loan, that also improves your credit score. They still count utilization ratio on term loans, but that decreases over time. And remember, as you pay off a term loan, it builds your credit because you've made these monthly payments on time for however long the term is. One thing I want to point out, we're going to talk about this so much more later, but as a term loan goes on, your credit, the longer you have a term loan, the higher your credit score, the more it'll help your credit score. That's something that I wanted to mention to everyone. Next, we've got the length of time. That's measured in terms of months. We've kind of discussed that in terms of your payment history, and it has a large impact on building and when you're trying to rebuild your credit. And the length of time is the length of your credit history is very sensitive to new accounts. One thing that I'm going to mention is that when you get a new account, you get a hard inquiry. We'll talk about that here in a second, but you're going to get a hard inquiry. Plus, it's going to be a new account, which decreases the age of your credit length, and it's going to decrease your FICO score for approximately 3 months. Now, don't quote me on that. I keep saying on average and approximately. We don't have exact figures on this, but it takes approximately 3 months for your credit score to recover and get back to where you started the instant before you applied for a new card or for a new account. So just remember, it costs you for 3 months. Length of time is the average age of your accounts, the age of your oldest account, and the time since a new account was open. So Experian kind of goes into detail about that, but basically, in fact, what they say is as a general rule of thumb, a longer credit history is better for your credit scores. Okay, it doesn't get much simpler than that. I don't think I could phrase it much better. And now we're back with the illustrative FICO scorecard. Down here, it's showing the number of months in a file. And I wanted to show you guys this, that if it's your first year that you have your file open, you only get 12 points. But what happens after you've had it for a year, your points increase to 23. Once you've had your credit for between 2 and 4 years, you get 25 more points. And then after you've had your accounts open for 4 or more years, you get the maximum points for this category, 75. Basically, what I'm saying is it takes at least 4 years to get the maximum points for your credit history. New credit and credit inquiries. Remember, like I'd said a moment ago, hard inquiries show the intention of acquiring more credit, and acquiring more credit basically increases the risk to potential lenders. Why is this person asking for more credit? Are they about to have a big expenditure? Those are the kind of questions that FICO attempts to answer by reducing your FICO score for the first few months after you get new credit. And to illustrate that over here, we've got number of inquiries in the last 6 months. So if you have 0 inquiries, you wind up with approximately 70 more points, but 1 inquiry costs you about 10 points. 2 inquiries winds up costing you even more than that. The second one costs you 15, and the third one winds up costing you 20 points. So applying for new credit reduces your credit score. I want you guys to carefully consider anytime you're going to apply for new credit, and I want you to understand that inquiries hurt the most within the first 6 months. In other words, this is specifically geared toward the first 6 months of your credit score. We're going to talk about this here in just a second, but one thing that I did want to point out, and I know that this is here, and I'm pointing it out to you guys specifically to let you know that I understand it's here. Does anybody see the, I'll say, inconsistency in these percentages and these numbers that we carefully came up with to this FICO illustrative scorecard? If you have 0 inquiries in the last 6 months, you're supposed to get 70 more points. But how many points are actually supposed to be allocated to this category? 50. So I will be the first to admit that my numbers are in some way inaccurate. I know that I'm the only person in the world who's going to come out and say, hey, I know my numbers are off. But the thing is, I'm giving you the best representation that I possibly can of how exactly credit scores work. And these numbers are slightly different than this number over here. But I want to I don't want that small inconsistency to take away from the overall principle that inquiries cost you points. So that's something that I wanted to point out to everyone. I know it's there, you know it's there, and basically what we're going to do is choose to work with what we have, which is if you have no inquiries, we're going to say that you get 70 points because the illustrative scorecard gives you 70 points. And we're going to say that this number is in some way slightly inaccurate. Now, hard inquiries affect your credit score for 12 months, but according to my FICO, they stay on your credit report for 2 years. Really, it's 25 months, but we're gonna go with 2 years for simplicity's sake. So after 12 months, it stays on your credit report for 12 more months, even though it doesn't affect your FICO score. Next, we've got credit mix. Now, credit mix is basically having different types of accounts. Credit cards versus auto loans versus mortgages versus student loans, things like that. It's basically a mixture of the different types of credit that you can have. FICO really likes it when you have different trade lines and different types of accounts. So the number of bank card trade lines, if you look at it this way, if you have 0 bank card trade lines, you get 15 out of 50. And again, this isn't exact, but if you get 1 trade line or 1 bank card, it gives you 10 more points. And then after that, wow, you get a whole 30 more points for 2. and then you get 5 more points on top of that for your third, and then 4 or more, it actually costs you points. So according to the FICO illustrative scorecard, the ideal number of credit cards is 3. And again, we've got a slight inconsistency here, 60 points, and the maximum available is 50. But according to the FICO illustrative scorecard, the optimal number of bank cards is 3. And like I was talking about before, according to our friends at Experian, the FICO credit scoring system tends to favor multiple credit accounts with a mix of revolving accounts. In other words, credit cards versus installment loans like mortgages and student loans. So, in my informed opinion and what I've seen, and I know that this slightly contradicts what we just saw, but we've already seen there's contradictory things. In my informed opinion, not based on factual evidence that I can show you from Experian or my FICO, but a appropriate mix of credit cards to term loans is 3 to 2 or 6 to 5. So that's what I've seen, and I'm going to show you in lesson 5 where I get the 6 to 5. So I'm just articulating that's my opinion. That's based on what I've seen. And you'll remember the sample credit report from lesson 2, potentially negative information over here, collections, charge-offs. We're going to discuss this in detail in lesson 7. And additionally, there is an advanced disputing class for graduates. And my FICO gives us a very similar range to what we've already discussed from Experian. 580 or less is poor. 580 to 670 is fair. 670 to 740 is good. 740 to 800 is very good. And 800 or better is exceptional. And like we've discussed, there are fines involved in having bad credit. In other words, below a 640 means that you're going to get about 1.5 points higher interest rate on a mortgage. In other words, a $300,000 loan could cost you $300 more per month. So rates fall as scores rise. In other words, you get lower interest rates as you get higher credit scores. So scores with a 760 and above get the lowest rates. And again, I'm kind of showing you specific examples. Now, I know interest rates go up and down, but the gap is pretty much going to stay the same. For a $300,000 loan, it could be a $328 per month difference. So know what FICO score you have and what your mortgage score is before you apply. I strongly recommend that. Well, if you go to your MyFICO and you wind up finding your credit scores are, let's just say 747, 751, 748, your middle score is going to be 748 right here. Well, what's the difference between a 748 and a 760? Well, it winds up being about $45 a month. Now, one thing that I wanted to articulate to you guys is the 748, the difference between these two scores, $45 a month, that is a lot added up over time, and especially if you use this difference to pay down your mortgage or to invest properly. But it's not something that should keep you from applying for a mortgage. So if 748 is the best you can do, I wouldn't wait around for those 12 extra points before you buy a house, especially if you can buy a house that's a pretty good deal at the time. Sometimes circumstance and sometimes timing in your life determines when you should buy, not specifically what your credit score is at that moment. Now, this comes from the insurance lesson that I do on the clue reports and your insurance credit scoring models. But as you can see, 40% goes to payment history for your insurance premiums. In other words, the credit scoring model is 40% to your payment history as opposed to 35% for your consumer debt. So it's very close. 30% level of debt, in other words, utilization ratio, that's the same. 15% length of credit, that's the same. 10% new credit, that's the same. And 5% toward the type of credit or your credit mix, which is 5% less. So it's virtually the same. The same principles apply. low debt, and no late payments. This comes from the Texas Department of Insurance. The highest 10% of credit scores, in other words, probably 800 or better, winds up having an average cost of claims per insured auto of about $200. Basically, it costs less for an insurance company to carry someone who has a high credit score than a low credit score, which would be about $350 per automobile. So I wanted to point that out, and I also wanted to point out this little outlier over here. This is a no score, and as you can see, the no score winds up being about the same as the lowest 30% of credit scores. So I would say that this is what, about 600 or so. That's what you wind up being scored as if you have no score at all. So always keep that in mind. Where can you go for free FICO scores? Well, the Experian app obviously has the Experian FICO 8. Wells Fargo has the Experian FICO 9. MyFICO has Equifax FICO 8. I know that Digital Credit Union says that they have the Equifax, but I don't know what FICO model it is. I don't have an account with them. Discover has the TransUnion FICO 8, and Credit Strong also has the FICO 8. The TransUnion FICO 8. So that's where you can go to get your different FICO scores without paying for them. Let's talk for a moment about how the updates happen. This gets a little bit complicated. You don't need to know it, but it's something that I want you guys to keep in mind. One time, a friend of mine, he had actually taken one of my classes back when I was first developing this particular class and teaching it in person. He got in touch with me and he said, "Hey, why? I've got an account. It's a $300 starting account, like you had talked about. Why is it that my credit score goes up and down, and it seems to be random?" And I said, "Well, what happens, and this apparently is updating every week. It's updating his balance. What happens during the month? Well, I wind up spending money just on gasoline. That's all that I put on the card. Well, as the month goes by, he winds up spending more. You can imagine maybe $50 a week or so on gas. Well, that builds his balance up to almost the maximum. Then he pays off the statement balance so that he goes back to a 0% utilization. So his account reports at least every week, if not actually every day. I'm not sure exactly about that, but he was basically asking me, why in the world does my credit score goes up and down so much? And I said, it's because you wind up charging up your credit card and then paying it off at the end of the month. So if you just charge your credit card one time with that one tank of gas, it'll stay the same for the entire month. And he goes, "Oh, now it makes sense." And that's why this particular slide is very important for you guys. I want you to realize that your creditor usually reports every month, but like I said, with my friend, I found out that sometimes it's weekly or even daily when your lender reports the balance on your account to the credit bureaus. Well, the credit bureau updates its files when it receives the new information. Usually creditors report monthly in what's called a batch. Usually it's a consistent day of the week or thereabouts within a few days. So you can kind of tell when your balances are going to be updated. Kind of where I'm driving to, when your credit is pulled, that gives you a snapshot of all of the information that the credit bureau has on you that day. The updated information is displayed. In other words, the credit scores only go off of what is reported to the credit bureau on that particular, what the most recent information reported to that bureau is. The simple idea that I'm trying to get across to you guys is that credit check, in other words, when your credit is pulled, that gives a snapshot of where your credit is at that moment in time, but it sometimes does not accurately reflect the most recent payment that you made. And one thing that I want to emphasize, most companies report monthly. What they report is the statement balance. So even if you pay your statement balance in full as soon as you get your statement balance, what the credit company is going to report is what your statement balance is compared to what your credit maximum limit is, which is going to cause you to have a higher utilization ratio than what you in your mind have. So if you want to have a low utilization ratio, and this is what I'm driving toward the entire time that we're talking about this. If you want to have a low utilization ratio, pay your credit card off before the statement cycle ends. In other words, have a zero on your statement cycle or $1 as a statement balance. So pay your account balance down before the statement comes out, but before the statement cycle comes to an end. So that's really what I wanted to emphasize with this entire discussion. The Experian, these are the apps. Okay, when you're monitoring your credit report, the Experian app usually updates the FICO 8 monthly. It'll also update based on an inquiry or any major change. Credit Karma updates weekly or daily, and it also updates based on inquiries and major changes. And bank apps usually update strictly monthly. And next, we're going to talk about what it is to not have a credit score. All right, always remember, and for mortgages, that's what we're really talking about here. For mortgages, that means that you would wind up going through manual underwriting. But always remember that if you have one bad debt, one thing on your credit score or one thing on your credit report, and it gives you a score, that's the score that the lender has to use to qualify you. So if you have one, even if it's a mistake on your credit report, that's the score that's going to be used to qualify you or not qualify you for a program. So always remember, one bad debt will give you a bad score, and that could cost you your ability to buy a house, even if you go through manual underwriting. 2% higher. In other words, if you have no credit score, usually it's going to cost you about 2% more, a higher interest rate than a 760 score. The same income gets you a lower loan amount, so you wind up having to bring more of a down payment, or you can only wind up qualifying for a lower sales price. And for manual underwriting, in addition to paying a 2% higher interest rate and perhaps qualifying for a lower sales price of a house, a lower quality of house, you need to have 3 different bills paid on time for at least 12 months, including rental history. Using canceled checks is usually best. Talk to your lender, but usually you need at least 3 different bills paid on time for at least the last 12 months to go through manual underwriting. Now, alternate scoring models do exist. Different lenders use their own scoring system if you don't have enough traditional credit. There's a company called Credit Vision Link provided by TransUnion. It can provide a score based on alternate data. Some companies actually use their own scoring system based on your history with them. So if you have a bank, it might, or credit union, it might look at your banking history with them as well as any type of credit that you have or don't have, and it can base a alternate credit score on deposits and balances, trends, things like that, and also address stability. And like we began this lesson, be prudent and acquire knowledge. I honestly believe that now you guys know, as my students, you know more about credit scoring than most of the people out there. So this has been kind of a long lesson. There have been a lot of numbers. I really want to emphasize that you don't need to know all those numbers, but if you're like me especially and you want to know where credit scoring comes from and where all these points are, we covered all of that. But but I want you guys to know that you don't need to know where all the points are, where they come from. But I do want you to know, and I want to emphasize the principles that we just taught using specific numbers. 5 main factors. The key takeaways are to make all of your payments on time. The principle, maybe I should call that 5 main principles. Make your payments on time. Keep your credit card balances low. Remember that scores go up the longer you keep an account in good standing. New credit hurts your score for a little while. It hurts your age of account history, and it gives you a hard inquiry. And having different types of credit will help your score. So those are the main takeaways from this lesson, even if you don't remember the specific points, the specific number of points, the percentages, all of that. You've got the main principles down. And as you guys know by now, I like busting myths. And one myth that's out there, I'm going to put it to you very bluntly. A lot of times people say bad credit is better than no credit. In the world of mortgages, I would rather you have no credit than bad credit because you're still qualified for manual underwriting versus having a bad credit account, which if you have under a 580 could require you to have at least 10% down. So always remember that bad credit is worse than no credit. The psalmist teaches us, keep your tongue from evil and your lips from speaking deceit. In the mortgage world, no credit is like having a bad credit fine, okay? And I also want to emphasize to everyone, like we're going to talk about in lesson 4, we can build good credit a lot easier than we can fix bad credit. So having no credit is better in the mortgage world than having bad credit. Now that we've got that out of the way. A lot of people are going to have questions moving forward. How do I build good credit? Our Rebecca character is going to have that question. That's answered in the very next lesson. We're going to talk about that in lesson 4. How do I make my credit score higher? We've kind of talked about that in this lesson. We're going to talk about that a little bit in lesson 4, but we're going to discuss the 850 credit score in lesson 5, how to maximize your credit score. And Curtis and Angela are going to be asking, how do I get qualified for a mortgage? Now, we're going to take them through paying down all of their debts, getting their debt utilization to 0 in lesson 6, and we're going to take them through the process of qualifying for a mortgage, hypothetically, of course, in lesson 10. So I want you guys to look forward to these lessons coming up. That's where we get more specific in terms of answering more of your questions. But in lessons 1 through 3, I gave you a really good background on how the system works, how to get your credit report, and now you know where your credit scores come from. And I like to introduce our professional members with this verse. Trust the Lord with all your heart and lean not on your own understanding. You don't need to understand all of this. And you know I really take this verse to heart. Sometimes God provides people to help you when you really need it. Our professional members participate in wise credit management to serve you by doing what they do best. And remember, you can watch these videos online, but you should also find a local meeting to come and share your difficulties and also your successes. Remember, we celebrate success. I tried to make it easy to find local groups and local professionals on wisecreditmanagement.com. You know, back when I was younger and just starting out, in fact, it was before I became a real estate professional, I found a house that was a really good deal, so I put it under contract. It was being sold by a couple that was getting a divorce, and it needed a lot of rehab work. It was a really great deal, and I had a pretty big down payment. So I went down to my bank, and they actually said no. And the guy who turned me down was actually kind of rude about it. Luckily, I didn't give up, and I found a different bank who would do the loan for me. But while I was building this class, I decided I wanted to make it a lot easier for you to find somebody who can help you. All you need to do is type in some details about your situation, and you can have up to 3 professionals contact you about how they can help you. So whatever your situation is, maybe you've got a rehab that you want to do, Maybe you want to get an FHA loan, but you've got bad credit. Whatever it is, you can enter some details about your situation and we'll help you find a wise credit professional to help get you approved. Well, what if you want to find a great deal like I found, but you're not sure how to go about doing that? Well, what you need is a buyer's agent. What you should do is enter in what you're looking for, and we'll help you find a local real estate agent that can help you find the deal that you need. Just type it in, and we'll help you find a professional that'll work for you. And of course, you need insurance, but really what you want is the best coverage on your home for yourself and your family. And guys, don't be like our friend Charlie and have a major health problem without life and health insurance. Especially if you're buying a home and you have a family, please contact an agent to get yourself proper coverage. And guys, if you have to make major decisions about your retirement account, especially if you're going to withdraw money for the down payment, please talk to a certified financial planner. Also, if you're a freelancer or some type of gig worker, please contact someone about getting a Roth or a self-employed retirement program started. And guys, if you're behind on any of your bills, maybe late fees are being added onto your account, maybe you're considering bankruptcy, please contact a certified credit counselor about a debt management plan to see if you qualify for Chapter 7 or if you need to prevent foreclosure or automobile repossession. It's time to talk to a bankruptcy attorney. On the other hand, consumer protection attorneys specialize in the Fair Credit Reporting Act and suing for violations, so they can actually wind up getting you money out of these companies that are harassing you. And credit repair organizations can help you by professionally disputing bad debt. Many of them are former or even current mortgage professionals who know the laws on disputing and how to get things removed from your credit report. And finally, if you need a reliable and inexpensive car like our class mascot, the Golden Nugget, then you should contact one of our dealers who can help you find what you need. What's our homework for this lesson? Well, as you can see here, I blanked out what the credit scores are. What are your credit scores? And why do you think that you have those scores? This entire lesson has been about you being able to, we've already set up free credit monitoring, but now we want to focus specifically on what your scores in each app are. And obviously, do you do you need to know your mortgage FICO score? If you're going to be applying for a home loan here in the near future, you want to know your mortgage FICO score. Additionally, I always encourage everyone to do the same things. Write down the major events that you have in a journal so that you can see how each action affects your progress. You want to keep track of everything that you're doing, and hopefully over time you're going to see good results. I want you basically to create your own success story. Always remember to join our community on the various social media outlets. We have groups, updates, we share success, and we encourage each other. And if you're on YouTube, remember, like and subscribe. But remember, we celebrate success. Also, I want to encourage you, if you know anyone who needs this particular knowledge and advice, you can do them a great service by forwarding any one of these lessons is easily forwarded. I want to encourage all of you to forward this knowledge to someone else if you think they need it, or maybe they know someone who actually does need the knowledge. Remember, success is overcoming. I want you to stay focused on your goals and not your obstacles. You overcome by getting started, developing your goals, and applying the knowledge and the problem to any type of problems that you're having. Our next lesson, lesson 4, how to build your credit. Specifically, we're going to talk about the different companies that you can go to get term loans. You need 2 term loans like we talked about. We've got Credit Strong and Self Inc. And we want you to have 3 credit cards. Well, Self Inc. is kind of a 2-in-1 because it'll actually give you a secured credit card. And like I said over here on the left, it works with no credit or bad credit. So you can actually have 2 term loans and at least one credit card right off the bat just by going to those two companies. We also talk about the different types of the different companies that you can go to help you build your credit, even if it's a little bit low. And over here on the left, we list off several options that you have to help you build your credit. And we take Rebecca through a specific plan to help her build her credit. And at the end of 6 months, we're hoping that she has about a 650 FICO score. And after about a year, we're going to build her up to about a 700 credit score using 3 credit cards and 2 term loans. So that's all waiting for you in lesson 4. I hope to see you very soon, and may God bless you.